All right, so let's start. So we're gonna do some exam practice tonight, but before we do it, I got to give you this first question, which is a really, really easy one. So this is asked us for the risk-based capital ratio. It's a real simple definition. I won't give you 2022. I'll let you calculate that. But in the financial statements that we'll talk about tonight, they have these two lines that they give you. One's called total adjusted capital. That's essentially their net worth with a little bit of adjustments. Remember, capital for insurance companies and banks is their net worth. It doesn't include debts. So total adjusted capital, essentially their net worth might be slightly different. And then this number is regulators trying to be cute. This in the law, man, USA commented on this law 3 or 4 times. We couldn't get them to change it, but it's one of the best laws they've ever written. It was adopted by all 50 states really fast. But in the law, early in the law, they defined this thing called risk-based capital. And once they define risk-based capital, they have this thing called authorized control level risk-based capital. So authorized control level RBC equals RBC times 0.5. So they define it up front. So authorized control. So what are you going to do with that number? Risk-based capital is what you need from a regulatory standpoint. So what do you do with this authorized control level? What they say is you must hold capital equal to 2 times your authorized control level RBC. That was at the end of the law. At the beginning of the law, they defined authorized control level RBC as RBC times 0.5. And then at the end of the law, they say you need to have twice authorized level RBC. Would there be an easier way for them to do this? Yeah, if they had just left this out entirely and just said you need to have RBC. Now, why did they do that? Their argument was we got to obfuscate it because if we don't, the press is going to pick up that number and report it for all the companies. It's going to make it confusing. So they published the law, published for RBC, and it took the press like a nanosecond to figure it out and publish it anyway. It was a complete waste. We commented, that's one thing we commented on more than anything else, is why do that? All right, so risk-based capital is how much capital you have versus how much you're required to have. But remember, this is half of what you're required to have. So what would the RBC ratio be? It's going to equal your adjusted capital divided by authorized control level times 2. All right. I want you to know that because if you get this RBC is pretty important. This is about the only place you can get the numbers. You can't actually get the RBC anywhere, but if you know that line 29, you just need to multiply that by 2 and you can get an RBC ratio for everybody. So let's say you're starting on a new job at an insurance company and they say, hey, how does our RBC look versus other companies? You'll know to make that adjustment and you can get that in numbers pretty quickly. So for, let's take 2020 RBC ratio, it's just going to equal 20,537,000,000, I'm going to round, divided by 2917 times 2. All right, and it'd probably be like 500% or 400% or something. All right, and you just put that in. So real simple question. I just want to make sure you're aware of that adjustment that they make. All right, so see how much of this you can do without looking things up, because we spent a lot of last time. This is the exam question from last year. Thank you. All right, so the first one, pretty straightforward. So I think I said 400%, but I can't multiply. So that's essentially 12 billion over 6 billion. So you took, and here you definitely can round. You could do 244.5 divided by 2966.2 times 2. What did y'all get?
2.06.
2.06, 200, and you actually put it as percent. So they say it's 206% risk-based capital ratio. Any questions on that one? That one's somewhat of a gimme. All right, let's try these. All right, so if you look at the question, let's figure out what years. The 1 year, well, this one's really straightforward. We just have to know we're doing 2017 business. So for 2017 business, you use the ending number, then you use the two previous. So it's a pretty straightforward formula. I'm on the right year, I think I am. So the 1 year, it's pretty straightforward. You just take the latest year, 17, 778, 283, minus the previous year, 17, 738, 400. And what did y'all get?
39,883.
Oh, I did something wrong. So 17, 778, 283, 17, 738, 39,883.
Yes.
Okay. Remember the negative sign is important. Here it's positive, so it works. I should give y'all one, at least one that has a negative sign, so it's positive. A positive sign is bad, a negative sign is good. Positive sign means I didn't reserve enough. Negative sign means they over reserved, so we generally prefer a negative sign. Right. Then the 2 years, the same number, 17, 778, 283, but here we multiply 2 years ago, 17, 603, 276. And what did y'all get?
175,007.
All right. So that's kind of a gimme question too. All right. Third question, the reserve set up for 2017 accident year. We're doing 2020 balance sheets. 2017 for 2020. So there's the overlap there. 2017, 2020. And then the same thing down here. 2017, 2020. So here we have 16, 641, 062. And up here we have 17, 603, 276. So we expect to pay out. Now here I'm using this number as 2020 because we're asking for the reserve you would have set up in 2020. You wouldn't have known about the better number in 2022. So that's the number we're using. So we expect to spend 17,603,000,000, but we've only paid that much. So the difference is going to be your reserve. And what did y'all get there?
62214.
How much?
962,214.
Yep. Or well, 962.
Yeah.
214.
Yes.
Does that look right?
Yes. Sir.
All right. So that's your reserve.
Excuse me.
Now this next one, so the way I have it worded is, I'm not being exactly correct, but we'll talk about this. So it's kind of a philosophical, but I want y'all to calculate it this way, just so everybody has the same answer. But realize when you do that, you could debate what this means. So using the most recent information, so we're going to be using column 2022. How much was 2019 income misstated? 2017 business. So we're going to go back to 2017. So here we're going to need the best number we had. We're going to compare that to the number we had in 2019. So think of this as an expense. So we ultimately think this is going to, the 2017 business is going to cost them 17,778,000,000. But when they set up their reserves in 2019, they did 17,845,000,000. So they over expensed. So was their net income too high or too low?
It was too low.
too low, all right? And so you take 17,778, 283 minus 17,845, 202. So they overstated the reserves by 669. So net income understated by 66,919,000. Now, I'm not real picky if you say millions or whatever. That is 66 million, but you can just type 66,919. So the key is to get the 66,919 and to know that net income was overstated. If you want to be safe, say claims were overstated, which means net income was understated. So you got to make sure you're going in the right direction. All right, so what's the problem with this problem? Well, we know in 2016 they thought it was 17,937. So you could argue that net income is actually overstated because they released 100 million here, but I'm somewhat ignoring that. I'm saying if in 2019 they had known this number, what would their net income have been? The fact that they've already messed this up, all right? So just all you have to do is subtract those two numbers, all right? Ignore the fact that the previous year is wrong and that's going to affect the first current year. I'm just saying as of 2019, if they known what they knew today, how would their income have been changed, all right? Obviously, if they'd known this the whole way out, it would have been perfect. And you notice here, they reduced the reserves by 200 million. And then they say, whoops, we went too far. And they had to come back. It'd be interesting to hear the actuaries actually walk through what were you looking at. So if I could ever find Mary, the reservist at USAA, she could probably teach 4 classes for us. She knew her job. She was probably one of the best in the business. I don't know if she's retired. We'll have to ask Kirby next week if he's able to still make it, if he knows where Mary is. My guess is she didn't say, hey, I want to be a reserve actuary. My guess is she was an actuary and that's where she ended up. And just wherever you end up, you just become really good at it. All right, any questions on this? I think most students do tend to do pretty well on these. And it's going to look somewhat like this. One thing I'm having trouble with is Allstate, for some reason, is not putting their insurance annual statements out there. So 2021 is the only one I have, but it looks like I had 2022 last year. So I don't know if they changed their mind or what, but 2022's, I can understand 2023 maybe not being out there. You usually file with the states in January, February, so you would think it should be getting ready, but for some reason they're not showing it. They show other things. This is the fourth quarter statement. That's not really the same, the quarterly statement. We can see if it looks like the annual report. Yeah, this is the annual. Okay, so that's the problem, is they've got it mislabeled. All right, so that's part of it. Okay, well, we should use this then. Let me save this. Blurry twice. So this is the actual annual statement. So I have it on a quarterly. So what they do is they file stuff quarterly, and then they do the annual statement at the end. And then for some reason they listed that as quarterly. So I'll save that. All right, so we'll get into this. We'll look at some of these schedules. Before we do that, let's do some big pictures for our insurance. If you had my life insurance class, I can't remember how far we got on this. It's very, very similar on the life insurance side, with the exception of the actuarial stuff. The actuarial stuff is very, very different between auto and home and versus life insurance. But accounting for P&C in life, you essentially have 2 books, really 3 books if you count tax reporting. Insurance taxation is extremely complicated. So they have essentially 2 books. I have their GAAP, and we just called it statutory. When I started at USAA, they only did statutory. Because if you're a private company, if you're not a publicly traded company, you didn't have to do GAAP. But probably the year I started at USAA, USAA started to do GAAP accounting. So it was pretty interesting. Rating agencies like Moody's and S&P almost don't care about the gap. They only look at the statutory. We were doing gap and stat, and then Bob Davis came along and he didn't care about the stat at all. So we started showing a lot more on the gap side. If you get USA's annual report, it probably was statutory years ago, but today it's all gap. So there's no statutory in there. So gap follows FASB just like any other gap does, but insurance companies have a lot of special gap rules that normal companies don't have, just like banks have their own special things. Gap is supposed to be realistic, where the goal is to be conservative. The goal of statutory is to make sure you don't go insolvent. So they're going to increase your expenses, reduce your revenue, increase your liabilities, reduce your assets. They're going to be conservative. The goal of gap is to help people forecast earnings. You're really trying to help the stock investors forecast earnings. Now, all that stuff we talked about with Schedule P applies on the gap side as well. If you look at Allstate, their net income for this last year was, boy, they've had some horrible years. So last year they only made $31 million. Boy, I don't know what happened to them back there. That's pretty pathetic. But there's 31 million. If you go back to over here and look at some of these differences here, um, 24 versus 23, that's like 900 million, isn't it? And they made 31 million. There's a $900 million adjustment right there. There's another 200. So if I were looking at their gaps, I would be making the same adjustments we're making to bring their net income back to the right level. So this number is actually it's actually worse than that, right? Because they added a 900 million because they had to reduce reserves. No telling what that 1.9 is. That could be also the same type of issue of some adjustment in this prior year here. You'd have to look through it. This looks really cumbersome, but once you get it set up in Excel and you're pulling the data in, you could easily adjust the firm's historical GAAP earnings by making those adjustments. So the goal of GAAP is to help you forecast earnings, but they don't make those adjustments. You almost think they would go back and make those adjustments. It is consolidated. Statutory can be consolidated on the P&C side, but hasn't been on the life insurance side. But here the focus is on the income statement. Statutory, the focus is on the balance sheet. The goal is to prevent insolvencies. They don't even call net worth. They call it surplus, like it belongs to the policyholders. Now, P&C is consolidated, but they do not consolidate P&C companies with life insurance companies. So there's no consolidated USA, including the life insurance company. USA's life insurance company is just shown as a subsidiary on the parent company at USAA. The other big difference you see with insurance companies is how the revenue is reported. They separate premiums from investment income. Now, if you go to Allstate, they do separate it out, premiums earned and investment income. The premiums earned look massive. That looks like the majority of their earnings. But remember, if you have a combined ratio of 96, most of that's going to be expensed away. Whereas there's no expenses here. That's all kind of like just gravy. That's all their money. So so you look and say, wow, that's where most, and I hear this on some of these podcasts, like 60% of the revenue comes from this or whatever. You don't say that with an insurance company. Just doesn't make sense. Same thing with the bank, right? Banks, how do you look at a bank? Any of y'all have seen a bank in a while? Since JP Morgan's stock price fell 7% here, how did their earnings look? You'll see this line right here. That interest income. Why don't they just show interest income? Well, for banks, you don't just show interest income. You do interest income minus the interest expense, and they net it. Other businesses do what? The interest expense is at the bottom of the income statement. For banks, they put that up front. So you'll learn, if you work for one of these entities, you'll learn real quickly that the accounting you learn undergraduate, you can throw a lot of it out. The debits and credits still work. You still do debits and credits, but the way financial statements look is very different. Yahoo Finance has struggled with this because you notice there's no gross margin up here. Banks and insurance companies don't have gross margins. It's a very different type of business. So anyway, it's just, but that's kind of an advantage, right? If you're an investment, if you're a finance person taking this class, you could spend your whole career as an insurance analyst. My best friend out at Victory Capital, he started off as an insurance analyst because he worked on the insurance side as an accountant. And so when he moved over as an investor, he could understand these statements far better than anybody else. It gave him a huge, huge advantage. In fact, he told me about this company. Y'all tell me if this company is having any problems. Let's go back the last 5 days, maybe. How does that look? Their stock went from 105 to 55 in a week. It sounds like a good week. So yeah, my friend in Victory Capital, he goes, "Hey, did you see what happened to Globe Life?" So when you're accused of fraud, it tends to have kind of an impact on the stock price. Anyway, it has nothing to do with what we're talking about, but anyway, just remember that. So investment income looks like a small percentage of the revenue, but it's a massive part of their earnings because most of that premium income is going to be offset by losses. So don't let that fool you. But you always separate this. This is also true on the life insurance side, is true for banks. You separate the investment income from the business. So you have operations, you have investments, very different business, which means what? What did y'all learn the formula for asset turnover is? Do you remember it? Anytime you see the word turnover, what's in your numerator? Revenue, what's your denominator? Whatever's in the title, what's in the title? Revenue to assets, right? There's no such thing as an asset turnover from banks and insurance companies. It makes no sense whatsoever. Because what revenues would you do? So think about it. Which revenues do they have that are associated with the assets? You have investment income to investment assets, right? That would make sense. And then you have premiums to operating assets. You'd have to separate those two out. If you remember doing ROE decomposition, you can't separate these out because you would add them. I mean, you were supposed to be able to multiply. You can't multiply that out. So it makes that ROE decomposition really tough. When I was at USA, I tried to create an ROE decomposition for insurance companies. It was incredibly convoluted. It's very difficult to do. So what does this look like? This just looks like your investment return, doesn't it? Or investment yield, maybe? It's just what you're making on your investments. You know, if interest rates are 6%, you'd expect that to be around 6%. So it's a very different business. I've never seen any kind of turnover ratio for insurance companies. The other thing you might notice is free cash flow. You may have heard free cash flow in some classes. Y'all take Catapecum. Anybody? Did you talk about free cash flow a few weeks? Right? I've always argued this, but I was a little nervous. And then I heard the Motorin say this same thing. He says insurance companies and banks do not have free cash flow. So it's another concept of finance you can apply to the financial services industry. So just be aware some of the stuff, or a lot of stuff you're taught on the graduate. When you jump into an insurance company or a bank, it goes away. Yeah, I should have told you if you took Catapacum, you could have asked, did he bring that up? Banks and insurance company? Yeah, that'd be a great question for him. Email him when he says, I was just curious, without bringing up my name. Just curious, do banks and insurance companies have free cash flows? All right, then your cost of revenues is a little bit different. We don't really call, you don't see a gross margin for banks and insurance companies. So your cost of revenues, it's the claims. How do you get claims? Well, you have what you paid in cash plus the change in your reserves. That's what goes to the income statement. And that change in reserves includes what? What did we just do? Includes corrections per years, right? If I can type includes, y'all remember that, right? We just did that. So your change in reserves also includes those corrections. Hey, we thought we were going to pay out 18 billion. Now we think it's 18 billion 200. That's part of the change in reserves. All right. So it's both a growth in business. You have more people, you have accidents, whatever. Your reserves are going to fall when you pay a claim, but then they rise as you have new business, and they also rise and fall as you make corrections. So what reserves do you have? So let's look at Allstate. Look at their balance sheet. Do you see any big numbers on this balance sheet? Well, you don't now. Any numbers stand out to you? The very first one, that's your loss reserves. How did they get that? Part 2 minus part 3. Remember? The total we expect to pay minus what we have paid. $23 billion out of $50 billion in liabilities. So about half of their liabilities is the reserves. Any other big numbers you see? Unearned premium. That's another reserve. What in the world are unearned premiums? Boy, this is a hard one to explain. I think I have it in my notes. So you're used to unearned revenues in normal companies. That's not what this is. All right. I think I have it defined in here somewhere. So unearned premiums, I'll just have to tell you. So essentially what they mean by unearned premiums is I'm going to go to my definition so I don't say it. UEP. Let me find that. Yeah. All right, I'll just show you in Allstate. All right, so what they're doing here is they have premiums that they've written and they haven't earned it yet. So if you sell a policy in December, yeah, maybe I can show you mathematically, it'd be the easiest way. You're going to find this is statutory accounting. It doesn't make sense. In fact, some of this accounting is accounting the state set up because we didn't have computers. And so when you didn't have computers, what they make you do is set up a liability that doesn't make sense, but they let you offset that by setting up an asset that doesn't make sense. And so what they do, a written premium, it's the total risk assumed. So a good example is you sell a policy in December with a premium of $100 a month. Let's say this is on December 1st. All right. How much premium are you going to get over the next 12 months? It's going to be $1,200. How much did you earn this year?
1,200 minus what you lose, then
Well,
Nothing.
just premium. How much premium did you earn?
Nothing,
Well, let's say that you sold this policy December 1st.
right, but you're not collecting money until January.
Well, it's not about collecting money. You wrote the policy. So we're ignoring if they paid us or not.
Oh,
So you wrote 12-month policy, but only 1 month has gone by. So what's your earned premium?
$100?
100. Okay, the unearned premium reserve is going to be 1,100. They actually have to set up 1,100. That is so bizarre the way they do it. Why do they set that up? Well, they say, you know, you're probably going to have to pay out most of that in reserves, but because you haven't earned a premium yet, your actuary doesn't set that up in a reserve. So we're going to make you have to put, because you took the whole risk here, didn't you? Doesn't matter when you get the premium. If they have a major accident in December, you got to pay it out. So they're saying you took the whole risk here. So they make you set up this reserve to capture the fact that you took the whole risk here. And that's what that unearned premium reserve is. It's a massive number. So take those two numbers together. 24 plus 16, you're up to 40. 40 of your 50, you're already almost there to the total liability. It's just those two reserves. Any other reserves you see? There's one more big one left. Yeah, the LAE, what is that? Same as this, but this is the claim to the customer. These are your lawyers, your adjusters. That's the reserve for them. You haven't paid them yet, and they may not even gone out yet, but you know they're going to go out and have to do something, so you set up a reserve for that. That gets you up to about 44. 44 of your 50 billion are those three reserves that all come from the actuaries. So, yeah, let me get back to the notes. Just be aware on cost of revenues, there's this really bizarre reserve. You don't count the premium. The only premium you're going to put in your income statement is the 100. But you have to set up this unearned premium reserve. We'll get into more examples of that later. The normal accounting is they have taxes, but they pay the states. Their expenses, they have salaries, benefits, they have the normal expenses that you have, and you can actually see those in here. They have an expense exhibit. I mean, look at this. This is incredible. They have incredible detail. Product, all the way down. And on the auto, they break up auto between physical damage and liability. They break out commercial lines. Be pretty incredible things. And they do it for all different things, reserves, expenses. Look at that detail. I mean, it's pretty amazing. So here's their expenses. Advertising, bureaus, underwriting reports, audit, salary related items, which is obviously going to be over half their expenses. And welfare, you take those lines and you're well over half. Travel, I still have nightmares. They have to list everyone that traveled from the most expensive to the least expensive in the annual report. And guess whose boss was the #1 person in USA's annual report? So my boss spent more money traveling than the CEO did. Now, of course, the CEO had the corporate jet, but my boss, now he had a big family and they let him keep the travel miles. So that may have had some incentive. I'll put this on tape in case he ever watches it. Guess he was like #7 on the list. I was. I didn't travel again for the rest of my life in that company. My friends, oh, the hassle I took. It's like, what are you doing, man? But he had me travel everywhere. It was just crazy. But he traveled a lot. He would switch to first class so he'd get more travel miles. It was just, he took his entire family of 9 on major vacations just from the travel miles he got. So I think there was some incentive issues there. But yeah, these statements have an amazing amount of details that sometimes it's even embarrassing. I mean, USA's CEO was on that list. He wasn't as high as my boss, but he was on that list. So they have to list those type of things. Rent is there. Now, we'll talk about rent a little bit more. You might say, well, if you own your own building, you don't have rent, but you actually pay rent to yourself. So you have rent as an investment income and you have rent as an expense, which is bizarre, right? GAAP would never do that, but they do it here. Equipment, depreciation, they do depreciation. Printing and stationery, why is that separate? Because that used to be real important. Postage is there. I guess that'll go up in July. Legal audit, but there's our expenses. And then they break out taxes separately. This is not income tax. These are taxes that you pay to the states, right? Income state taxes are a different line. So amazing, amazing detail. You will not get this kind of detail in a GAAP financial statement. It's just not that kind of level. So it's actually pretty cool, the stuff that you can get out of these. As far as premium taxes, it's pretty cool. You can add a lot of value in your company by doing some premium tax adjustments. So premium tax, every state will collect a tax as a percentage of your premiums. If you collect $1 billion in premiums, they're going to take 1%, 2%. What states do is they play this game. They'll say, hey, if you're a Texas company, we'll only charge you 1%. But if you're not a Texas company, we'll charge you 2%. Well, that sounds good. And then Florida says, hey, we'll charge you 1%, but if your state, Texas, charges our companies 2%, we're charging you 2%. That's called retaliatory tax. Isn't that cool? How states are fighting with each other. So USA sat down and they went to Texas and they say, hey, if you'll change your tax rate, we'll pay less in tax in Florida, but you'll actually collect more tax overall. And they showed them the math and they went to every state. And so they convinced Texas to change their tax rate on other companies, even that would help them correct, it's pretty cool, pretty funny. So they actually charge a penalty if your state does something different. That's called retaliatory tax. USA got sued by the state of Texas because the state of Texas wasn't paying its franchise tax. And there was a state treasurer called Rylander. I don't know if y'all remember her, probably before, if y'all probably weren't even alive. Well, let's see if she's still out there. Texas treasurer Rylander. She's out there. Carol Keaton Rylander. Do y'all remember her? Is she still alive? 1938. I wonder if USAA's in here.
Oh, yeah.
No. So she sued USAA. I knew her last name because there was a Rylander's grocery store in Austin, and she was married to that guy. I guess she's gotten married a couple more times. Y'all recognize her at all? When was she the state treasurer? Oh, 1998. Y'all weren't alive in 1998, were you? So okay, so you wouldn't know. So she sued USA. She was upset because USA wasn't paying franchise tax. Well, the state law says if you pay premium tax, you don't pay franchise tax. So USA is like, it was a break. We're following the laws. So she was going out on TV and say USA is not paying its fair share. You take 2% times USA's premiums in Texas. It's a massive number. It was much more than they would have paid in franchise tax. But anyway, so that was an interesting. USA won that, and we just kept quiet and just kept out of the radar because we knew she was wrong. But it was a pretty interesting thing, especially she was a Republican. She thought she'd been a little more business friendly, but so it gets pretty complicated. But there's a lot going on here. My job at USA was to try to save as much as premium tax as we could, because certain states had these rules. If you did certain types of investments in the state, you got to offset your premium tax. So we were able to save USA hundreds of millions of dollars of premium taxes by doing those investments. So there's a lot there that you could do. That's pretty cool. All right, so some special accounting rules. One thing's called deferred policy acquisition cost. I don't know if we can see this in Allstate. In the income statement. It probably would be on the balance sheet. You won't see this on any other insurance company. It's an asset. Ah, y'all see it? There it is right there. I challenge you to find any other company that has that other than an insurance company. Life insurance and P&C both have it. Any guesses what that might be? It's a big number, $5 billion. Well, guesses? So what this is so bizarre. I remember the first time we told our new CEO, is like, you do what? So it's very expensive to put an insurance product on the books. You got to do underwriting, life insurance side especially, you got to do blood work and all this. So it's real expensive. So a lot of companies, when they issue new business, they're losing a lot of money. And so what GAAP accounting said is, okay, if you spend $1 billion doing blood work, underwriting, getting these bureau reports, you get to capitalize that as an asset and you get to amortize it over the life of the policy. Really bizarre. And this includes marketing and all kinds of costs in there. So it's a big number. I can't see their total assets. It's got to be in there. It is. So it's about 5% of their total assets is in, more than 5% is in this line. Very, very bizarre. It's only in GAAP accounting. It's not in statutory. So how difficult does this get? So this is an actuary job. Y'all take accounting? Did y'all, the actuaries take accounting? Y'all do LIFO inventory?
Mhm.
Did y'all do LIFO unlocking? Y'all remember that?
No.
LIFO unlocking, I thought it was the most complicated everything I've ever heard other than currency accounting. So what LIFO unlocking means is you're putting your inventory on the books, but you're doing last in, first out, which means some of your inventory has really, really low costs because you probably sold it, but you're counting it in an old cost. What happens in a really high inflationary environment is you can get some strange numbers where GAAP requires you to make adjustments. DAC does the exact same thing, but it's far, far more complicated. Only actuaries can really explain it. I understood it one day for 7 minutes. An actuary came in, he explained it to me, I understood it. And 7 minutes after he left my office, I was like, okay, what did you say? It was so complicated. It's far more complicated on the life insurance side than the P&C side because there's something goes on with interest rates that's really strange. I couldn't explain it to you today. But that's kind of exciting. So I tell students, you know, when you work for a new company, you're trying to figure out what are those strange, really complicated things about this company. You try to learn those things first. Go figure them out, ask questions. Use that as an excuse to ask questions. So if someone comes to your desk with a number, ask them, hey, how's this number calculated? They'll probably say you don't want to know, but you say, yeah, I do want to know. Explain it to me. And they'll take you to an actuary and they'll explain it to you. That's one of those things that's that kind of complexity that's really, really tough to understand. It can be quite material to financial statements. And the reason they do that is the matching concept. You incurred all these expenses up front for something you're going to benefit from this policy for the next 10 years. So we allow you to set up that, that asset. So it reduces your expenses because instead of expensing it, you put it as an asset on the balance sheet and you amortize it out. All right, so you won't see that on all states. So what I want to do, I'm going to use, is this the most recent one? 2020. Okay, I'm going to use the 2023. So what I recommend you do is keep track of which page number I'm talking about. And I'll put this out on Canvas if Canvas will let me. I don't know how large this file is. It's probably a pretty good size. Put it on our website. I mean, on our drive. It is, oh, that one's kind of big, isn't it? 92. So hopefully I can put it out there. So I'm not going to walk through the entire thing because it's 782 pages, but I want y'all to be aware that there's some incredible data here. Bloomberg has some of the statutory data, but not much of it. One thing Bloomberg does have that I will show you is they do have combined ratios. You can bring in combined ratios for different companies. They won't do it by product line. They'll do the entire company, but that can be really, really quite helpful. And I'll show you a title insurance company whose combined ratio is what? Like 5% versus an auto insurance company like Allstate whose combined ratio is like 95, 96. So I'll go, all right, we'll stop it there because I don't want to get into this yet. Okay, I thought we'd start with this because this is pretty cool. So this is what Bloomberg provides. I brought in all of the companies in the P&C industry. The largest is Progressive, which is not a very big company, 122 billion. So, we're thinking $1 trillion, even $3 trillion companies today with Microsoft and Apple. But yeah, we can't get the screen, so we're watching by Zoom.
Oh, okay.
Until it's IT probably gets here. So what they provide us is the combined ratio. They start with that. You can see with Progressive, their combined ratios are pretty consistent. Look, especially last few years, 90 to 95, really, really consistently each year. That's pretty profitable too, right? In 2020, it dropped, because, you had people not driving. And then it jumped in 2021. We've seen that. I should update the date. Sorry, I have to run this again with 2022. You're definitely noticing the combined ratios for auto insurers, which is what Progressive is, definitely jumped in 2022. So sorry, I forgot to change the year. Then they show the expense ratio. You can see high teens, low 20s. This is what I was talking about with USA when they had the restructure. USA's expense ratio was like 30%. If you're 30%, and your competitors are 20%, you're in a lot of trouble. There's the loss ratio, which is just your claims, doesn't include LAE. Yeah, it's just put up there. So I'll show you some title companies where you'll see the loss ratio is incredibly low. Their loss ratios are. If you're noticing,
loss ratios are.
yeah, that turned off and turned on.
Yeah.
But if you look at Progressive versus, we have to find a homeowners company like Allstate. So with the firm like Allstate, you'll notice in the combined ratio, Harvey year, Katrina really hit that much. Oh, well, since what's your work on that? I did hear back from Kirby. He will be here on Monday by Zoom. So we got hopefully, we'll definitely get started on Monday. I told him, what we've been talking about, so, he's open to anything. I do hope he'll show us a kind of reinsurance schedule. What I showed you for Allstate, but one that makes more sense. So hopefully you'll see one of those. If you have specific questions you really want to address, especially those doing the CAT, the global warming one, let me know. We can send it over to them. I mentioned the podcast that talked about Andrew and Northridge and see if I'll talk through that. But he sent me his slides. I'll look at them and see what he has there. All right, so let's go find a title company, and there's one near the end. If you look at line 48, so we'll go across. Here's their loss ratios. Does that look a little unusual? 10%, 5%. They even have a year where their loss ratio was negative, whatever that means. That's pretty cool, right? You write insurance and your customers make you money. That probably has to do with reserve weakening or something. So, but look at these last few years. My word, isn't that? They're almost paying nothing out. Not to keep putting this product to death, but why would you pay $100 when on average you think you'll get $2 back over time? It just doesn't make sense. It's crazy. All right, let me show you, see if I can show you Allstate. We think Allstate be up near the top. Oh, there it is, line 6. So you can look at Allstate and Progressive together. What's the first thing that stands out with Allstate is you're seeing more 100 combined ratios, right? Let's see. Again, remind me what Harvey was? Was it 17? Okay, they didn't really jump in 17. So you don't really notice that they're a little more stable here recently, and they're real similar to Progressive. If you notice, pretty similar. But it is generally higher, and you will get the 100 years. Like, I don't know what happened in 2011, but you will get the 100. Usually, a firm like Allstate versus Progressive, it's the homeowners that creates the volatility because Progressive is entirely auto, and so you will get that kind of jumping around. All right, so I just went in to Bloomberg. Unfortunately, all I could get was combined ratios, loss ratios, and expense ratios by the whole company. What you'd love to be able to do is get it by product line. But since you can't do it by product line,
I had to minimum everything, but
okay.
look at all the stuff that you should be good.
All right.
Yeah, no problem. Anything else I can do for you?
No, that's good. Thanks. All right, sorry about that. I probably did that, but so it'd be nice if we could, but here's what Bloomberg, here's the function. IS combined ratio non-life, which is strange to me because there's no such thing as a combined ratio for life insurance. So why they say non-life, I don't know. But if you know these, you can bring those in. There's the expense ratio, non-life again. Life insurance does have expense ratios. I don't know why I brought in so many years. And there's a loss ratio. I don't have the LAE ratio. I can't remember if they actually had that one. You can figure it out though, because it's essentially the combined ratio minus the expense ratio minus the loss ratio would be in that. And then I also brought in their return on equities. You kind of see what kind of return they made. And I think I brought one last thing in. This one is their investment yield. Kind of what investment returns we're getting. And this, you wouldn't expect huge differences between the companies. I mean, there's a few Hartford. Now Hartford and 08, that was their big blow up with their life insurance company. Why that's affecting their P&C company, I don't know. They should be P&C only numbers. I mean, it's possible. I had to take that back. It's possible the total invested yield is both their life and P&C combined. That's possible. I don't know. It's hard to know how they do here. I mean, look, you can just see interest rates falling and their yields fall. Oh. And the one other thing you can do is this. This is pretty cool. The CIE, which I don't remember what that stands for, DES, gives you a description of the company, which is really, really helpful. That's how I can find the title. Oops. That's how I can find the title companies. So there's a Fidelity title company. But the title might not be all that they do. It says provides title insurance, technology, and transaction services to real estate. So that looks like it's a pure title company. Go over to their loss ratio. Look at that. Does that look like a title company? And compare them to the others. I mean, it's just they had a bad year back then in 2008. Who knows why 2008 was bad for them? I guess people were claiming other people's houses offset the loss. But okay, here's CNA. So what is CNA famous for? Anybody remember? We talked about on the commercial side. They're the asbestos people. So asbestos, you can kind of see, but it's the same company as Lowe's. Lowe's owns CNA, so that's the numbers should be similar. Yeah, it's possible some of these years, man, look at that one. Some of these years are related to asbestos because they have set up extra reserves. They look like they've done pretty well here recently. So if we come over here on loss ratios and do equal median, it might not work because one guy to help me on medians, what I do is if there's no data, I have it put 2 quotation marks. But for some reason on the medians, it counts those as cells. I want it to be a blank cell, not counting the median, but I can't get it not to do that. If you look at the loss ratios over time, I gotta take out just a second.
Like you did it in function?
Well, I did it in function and said there's no data to give me 2 quotation marks. So I just want an empty cell. But Excel doesn't interpret it as an empty cell, it interprets it as there's something there. So when you do the median, it's there. So it's kind of frustrating. So well, it does look like the early part is pretty high, but look how consistent it is, right around that 60. So you actually raise a loss ratio of 60%. Just have that in your mind. That's pretty good. What about an expense ratio? Boy, I really did pull in way too much data, but that's all right. Expense ratio. Much higher than I was expecting. Progressive is really low. Geico is really low. So there you're around the 30. That's really high for P&C company. Allstate are, well, we can look at Allstate. Allstate's going to be a little higher. So the key with the expense ratio is, are they direct riders or, so State Farm is much more expensive because they have commissioned agents. They have all these individual pieces. USA used to have a really low expense ratio because it was a direct rider. So everything did was by phone and by mail. So you can kind of notice that. But if we go up to Allstate, 35, getting back down to 30. 30 was probably for auto and home. 30 is probably a pretty decent number to use. Progressive, look how low Progressive is, though. You can see the huge advantage Progressive and Geico have because they're around that 20 to 18 to 20% range. Much cheaper. Gives you, I mean, if you're, Allstate expenses are, 40% higher. That's a big disadvantage. So I can't show you State Farm because they're not publicly traded. Look at the title companies. The title companies have really high combined ratios, but they don't even show them. They have 95% combined ratios. That's because their expense ratios are like 90%. It's all expenses. I mean, all they're doing is paying salaries. They're not paying their customers any. So I'll update this to 2022, but at least I found the file and it does work pretty well. All right. Let's walk through the premium side. So this is just definitional. So on Allstate's financials, on the income statement, page 4, here's your income statement. This top line, see what it's titled? Premiums earned. So what is premiums earned? What does that number mean? So you have to know the timing of the policy. So if you buy a policy, when does the company say they've earned the premiums or not? So when the policy is signed, that's written premium. The entire year is written. When the premiums for life insurance, so you think about it, you just sign the policy. When do they usually have you pay it? So what do y'all have? 9 months, 6 months? I think my USA Auto it's a 12-month policy. I'll pay it over 9 months or something like that. But they want it in advance, right? Because if they get it after the month, what are you going to do? last month, you say, hey, you know what, I didn't have any accidents this month, I just won't pay the premium because I don't need it, you know, so they want the premium in advance, but how far in advance? So you've got a premium that is written, that's when you take on the risk, you have it's earned, that has nothing to do when it's paid, that has to do with, you know, you've gone through time, and then you have the actual payment, but you also have when it's due. So it could have been due on April 30th, but they didn't pay it until 3 days later, so they were late. You know, I have all these kind of things. The insurance accounting has to account for all of those. So let's do an example. The policy is sold on March 1st. It's effective May 1st. So on March 31st, there's no premiums written, there's no liabilities. When does the premium written come in? On May 1st, that entire premium, $120 on May 1st will be written. They don't care what year you're covering, they just say that the second that premium is written, that's a written premium. So on June 30th, your written premium is $120. Right? Your unearned premium is $100. Why? Because as of June, you've only earned for May and June, only 2 months. So your unearned premium is still $100. Your earned premium is what? 20. Well, here's how they do it. An earned premium is your written premiums minus your change in unearned premium. We wrote 120 in premiums. Our unearned premium started at 120. Now it's only 100. So I mean, unearned premium started at 0. Now it's 100. So 120 minus 100 equals 20. You may not be thinking it this way. You might say earned premiums is it's $10 a month and they've only got 2 months. Obviously that's 20, but this is the actual formula you'll see in the financial statements. It gets a lot more interesting when you have multiple years all going on at the same time. You're writing premiums this year, you wrote some premiums last year, you're earning stuff. So it tends over time, maybe we can see it in Allstate. It tends over time, written and earned premiums tend to be real similar. They don't get radically off. But that's the way insurance companies think. There's absolutely nothing like written premiums on the life insurance side. They don't think in those terms at all. Now, the weird thing on insurance companies' balance sheets, let's see if I can find it here. Premiums. They have something called uncollected premiums. If you think about insurance, there's no real thing as an accounts receivable. If you don't pay your premium, what happens to you? Let's say you have an Allstate policy for 12 months and you just stop paying your premium. What does Allstate do to you? They just drop you. Right? They have no legal recourse. They can't say, hey, we gave you insurance, you got to pay us a premium. So they have no legal recourse. If you don't pay your premium, you have an accident, you can pay it real fast. There's a grace period and you can get covered. They can't say, hey, you didn't pay your premium. That's far more important than life insurance side where you have this grace period. If you died the day after the grace period, you're out of luck. But if you died during the grace period, even though your premium's late, you're still covered. So they don't really have a receivable. This is more related to there are agents collecting premiums. I haven't paid them yet. But there's some interesting accounts here you won't see on any other financial statement for any type of company. Deferred premiums is the weirdest one. So it can get pretty messy. The system's going to take care of all of this. It's all going to come through computers, so you're not going to really notice it. But so how much did we write? How much did we earn? How much have they paid? How much were they supposed to pay? All that's going to come in there. But you see what the unearned premium is doing, that reserve, what it's doing is helping you get to what you actually earned. And then what it's saying is, hey, once you write the premium, we're going to set up the liability for that entire year right then and there. Even though you haven't earned the premium yet, or you took on the risk, we're going to set up the premium for that entire risk. So it's really unusual. I can't think of anything similar on the life insurance side. And so when you're looking at financial statements, so let's look at this formula here. This is underwriting investment exhibit. I don't know why it says investment exhibit, so I don't know. This is underwriting. So this is net premiums. We'll have to talk about that. Anybody want to guess what net premiums mean? Any guesses on that?
Bless you. Bless you. Bless you.
All right, my sixth grade teacher said if you sneeze 3 times, you die. So I just started sneezing 3 times. Just to prove her wrong. All right. Net, so gross would be what? Gross is what we pay. What do you think they're subtracting out of that? Any guesses that Kirby's going to talk about?
LAE.
No, it's not LAE. What's Kirby going to talk about? So reinsurance. All right, you might have premiums of $1 billion, but if you're going to pay reinsurance, you're going to actually give those policies to another company. You subtract it out. So you have gross and net. So this is written premiums. Here's the liability, the unwritten, unearned premium liability. It changed from 23. Wow, that's a big change. 23 to 35. Wow, that is a big. I wasn't. Well, this is just fire. So let's look at the total. 37. They do the change in the unearned premium reserve. So 11 billion versus 12 billion. They're going to take this minus that, and so you see the written premiums was 37 billion. The earned premiums is 35 billion. So they have it right there in the schedule. Passenger auto liability. You can see they're about the same number. Physical damage is in there. Homeowners is in there somewhere. Where's homeowner? Homeowners. All right. So it's built right into the schedule. This is showing your premiums earned by product. If you're interviewing with an insurance company, this is an important schedule because it's going to tell you what business they're writing. There's other schedules that show you the same thing. But when I was looking for USA's competitors, I was looking for those that homeowners and auto is at least 50% of their business. You can see with Allstate, they've got about 9 billion there, 23, about 41 billion. Well, did I add it wrong? 21, about 30 billion of the 35 billion. So the bulk of their business is auto and home. And there's some others that are related to auto and home in there as well. They even have some workers' comp, which is really bizarre why they would have that. You see any other large business? There really aren't any others that are that large here. They do identity theft. That's kind of interesting. And it wasn't in the list, so they added down. So here's, the reinsurance stuff as well. So anyway. So written premiums versus earned premiums is very, very important. And you get the earned premiums by taking written premiums minus the change and the unearned premium reserve. We talked about the premium surplus ratio. All right, let's go through their financials here. Let's talk about what are the interesting things. So if you're interviewing with an insurance company, see if you can get their statutory blanks, because there's a lot of really cool information in here, including the first page. The first page is the jurat page. I don't know why it's called that. I don't even know what jurat means, but this is the jurat page. It gives you the identifying number for this company. They have an NAIC code, which is the National Association of Insurance Commissioners. They were organized in 1931. What do you think they were doing in 1931? You think they were doing auto in 1931? Forget when USA was formed. USA was formed entirely as auto. Y'all know what USA stands for?
United States.
Not United States. United Services. Yeah, United Services. So they start off as an auto insurance company because military officers couldn't buy auto insurance at a good rate. So USA started. They tell you where they're located. Obviously, they're in Illinois. They give you some contacts here. You might try emailing these people and, trying to get a contact that way. They don't give you the actual contacts, unfortunately, so you can't bother them, but it'd probably be pretty easy to get their chief actuary online and find out who that is. They give the board members, the key officers in here. And there's some important state laws that are real picky. One thing we discovered on all of these officers, you had to give their full name without abbreviations. And if you ever use an abbreviation, they sent it back to you, you had to refile. So we had an officer, his name was M. Stacer Holton. His first name was M. That was his name, his given name was a letter, and they kept sending it back to us. They thought it was his initials. So they're real picky. The rules are incredibly picky. When I started at USAA, we had just bought PCs to do this on PCs. So try to imagine that there was someone typing all of this back in the 60s and 70s. But literally the year I started USAA, they started doing these on PCs automatically. I mean, this thing's very, very lengthy. All right, then you have the asset page. What do you think the bulk of their assets are? They have $60 billion in assets. 49 billion of that is investments. What do you think their biggest investments? Does a life insurance company be easy? Be all bonds. What do you think a P&C company would be? And we'll talk about this. Well, it's mostly bonds. So 30 billion of it is bonds. In fact, the P&C industry is one of the biggest suppliers of municipal debt in the country or in the world. The P&C industry buys a lot of municipal debt. That industry would be shocked. And then they have stocks. The P&C industry does buy stocks. What you don't know about this number is how much of that is stocks they're buying of public companies versus how much of that is their subsidiaries. So you're not really sure on that. But that's the bulk. I mean, that's 35 billion of their 60 billion is that item. You have some premium accounts. Allstate is really unique, and they have a lot in other invested assets. They do a lot of options, private equity, and those kind of things. So that gives them a big number there. Now, what are these two columns? So you look at these columns. These are what they call non-admitted assets. What are non-admitted assets is the states say there are certain things we don't allow. And they subtract them out. And some things they don't allow at all. You might see some of these lines where they subtract almost the entire thing. So EDP, processing equipment, that's an old word. You can only keep a small smidgen of that. Furniture and equipment, you can't put any of that on your balance sheet. You subtract the entire amount out. Now, when I started, Texas was the only state that allows you to put furniture and equipment on your balance sheet. It's really strange. But yeah, if you buy a table or whatever, a truck, that all has to be written off to zero. You won't see non-admitted assets on the GAAP side. That's a very unique item. And it was interesting, EDP equipment, that's technology. I thought it was pretty funny when I started. Where is that line? Right here. This used to be 100% admitted. And their argument was if you buy a computer, that thing's going to last you for 20, 30 years. That was the argument when they started. And then suddenly it lasted you like a year or two. We had PCs. So they used to admit this. Now they're writing off a lot of that. So their assets are predominantly 49 billion of their 60 billion. So about 70–80% is just investments and then some receivables. When you get to the liability side, we already talked about that. The bulk of that is your loss, your LAE, and your unearned premium reserve. That's the bulk of that. You do have some interesting things here. So they do have debt. How much debt does Allstate have? Looks like zero, doesn't it? Is it really zero, do you think? Do you think Allstate has debt? What's going on with the stock market? So here's Allstate. And they have $8 billion in debt. Where is it? Do you know what Allstate does? So they don't have any debt here. What does USAA do? So it doesn't have any debt. USAA has billions of dollars in debt, but if you look on their statutory rank, it doesn't show up anywhere. Any guesses? It's not, no, it's not. You don't subtract cash. We talked about that, but it's not that. So what they have is, it's interesting. I had this teach a group of middle management from China. And I had to do it through a translator, which is horrible because you tell a joke in English and the translator translates it and nobody laughs. And now you're wondering, what did the translator say? And they probably thought it was serious. It was terrible. But this was the number one thing they wanted me to talk about. And I just like, that is so weird. But it was kind of nice because I had experience with it. Do y'all know what a holding company is? So most insurance companies use holding companies, probably banks as well. So Allstate does have a holding company. If we can find it. Yeah, it's not in there. I'm going to show it to you later. We're going to show it. But Allstate has a holding company. So that means there's a company that owns all other companies. It's at the very, very, very top. So Allstate Holding Company owns Allstate Insurance Company. And because the reason that is regulated, insurers do not want to borrow in public markets. You don't want a regulated entity borrowing in a public market. It's a really, really bad thing to do. So what you do all your borrowing through the holding company. Pays dividends, issues stock, everything's at the holding company level. That way, the insurance companies don't have borrowed money on their balance sheet. Why don't they like doing this? Because they don't want the regulators dictating what they can borrow or when to pay it back, all those kind of things. They just want to leave the regulators out of it. Right. So Allstate has a holding company. I'll show it to you when I finally get to that schedule. How in the world does USA have a holding company? Because USA's top company is a regulated insurance company. So anybody want to guess where USA's holding company is? Because I worked for that company for like 8 years. So for Allstate, it's going to be the top company. For USA, you have USA, the reciprocal. It owns something called USA Capco. It is a subsidiary of USA Reciprocal, the big company. So USA's holding company is a subsidiary, so it's unusual that they have to do that. State Farm probably does something similar. State Farm can't have a holding company either. It has to be a related company. So USA has something called Capco. Capco owns the life insurance company, the bank. Used to be the real estate company. I don't know if they have it anymore. They may have completely spun that off. And some other subsidiaries. But then Capco does all the borrowing. USA doesn't have any equity, but all the borrowing, repaying of debt. And so what Capco does is it will borrow money and then lend it to the bank, or borrow money and lend it to whatever, the insurance company. They borrow money and they loan it as intercompany types of transaction. So it's an interesting arrangement. This entity was created when I was there, and then I worked for it for I forget how long. I was an employee of Capco for a while there. But holding companies are important. So the middle management from China are trying to understand how to use holding companies in US, and I wasn't really sure why they were asking the question, but fortunately I had some experience with it from USAA. So no borrowed money. They have something on line 15. Have you ever heard that before? I won't make you guess on that one. So USA gets a few 100,000 checks on a day. Is it possible they can't figure out whose checks those are sometimes, which product it belongs to? So remittances and items unallocated, that's premiums they receive, but they have no clue who the policyholder is. And what the states say is, let's say, I mean, USA is going to deposit the check, right? They're not going to say, hey, we can't match this check. They're going to put it in the bank. Let's say Alex said, you know, State Farm won't sell me insurance. I'm just going to write them a check for auto insurance. They'll cash my check, and if I have an accident, I'll just file a claim because they cash my check. And the state says, well, you know, State Farm doesn't have time to look at every check. So they get to put it remittances items unallocated. If they discover to deposit a check for someone whose insurance they didn't want, they have the right to send that back and they have no liability. So the states say, hey, as long as it's in there, you're not accepting the liability. That way they can process the checks. Otherwise, it's be impossible. I mean, you have 300,000 checks, you just can't do that kind of detail. Now, how big of a number is it? So if you look at it with Allstate, it's probably not a huge number. It's $14 million, but it's not an inconsequential number. You know, it's there. So that's what that is. They don't have drafts. You don't know what drafts are. Drafts are kind of interesting checks, but they probably don't, you know, probably most banks don't use drafts anymore. And so that's just a line that's there from a long time ago. There was one other line I wanted to show y'all. They do have commissions payable to their agents. Yeah, I'm not seeing that line. The net worth section looks kind of similar on this page, but it doesn't on the next page. But anyway, there's the assets. So if you need to talk about assets and liabilities of insurance companies, it's pretty straightforward. The assets are investments, mainly bonds, especially munis. The liabilities are what? I just told y'all. What's your three biggest liabilities? Come on, y'all know it. I just shy tonight. What's the last word? Give me at least that. What's that liability called? All right. So their liabilities are loss LAE UEP reserves. That's probably 80-90% of their liabilities. So that asset side's pretty straightforward. Most of the other assets are receivables of some kind, but it's a pretty straightforward. We'll talk about why they do so much in munis. It has to do with because life insurance companies almost never buy munis. P&C companies buy billions and billions and billions of dollars in munis. And then the actuary set up so the accountants have all of this and the actuaries set up all of this. So that's essentially their balance sheet. And we get into the income statement. We already talked a little bit about that. We separate the underwriting from the investment side. So you have premiums, you have losses, which is the bulk of it, right? You have LAE, and then you have other expenses, and that's going to give you your underwriting gain or loss. It's pretty amazing. They went from 3.7 billion to just 682. I wonder how much of that is auto, because have y'all noticed your auto premiums jumping up? Supposedly this industry is losing a lot of money on the auto side. I wonder how much of that is auto. We could figure it out from the statement. We'll see how much auto dropped this year. So you will get that kind of detail. Then you have the investment side. Somehow their investments jumped last year. We're talking, this is 2021, so this is older data. I should have brought up the 2022. So anyway, 2021. You do have realized gains and losses, and that can be a big number. This is 2021, so my guess is 2022, this might be a negative number because interest rates rose, so they probably had losses on the bond side, but we'll see. I'll have to bring up that one next. You have federal income tax, just like you would have anywhere else, and you have your net income. Their net income is amazingly the same because the underwriting loss was offset by your investment side. So this might be due to interest rates rising as well. And then their capital account gets really, really, really detailed. You don't see this on GAAP accounting where you have all of these different lines. We don't need to know what these different things are, but there are some pretty interesting. There's the non-admitted assets that come out. Let me tell you real quickly on this surplus notes. Allstate doesn't use them, but they are pretty common. Have you ever heard surplus notes before? I think it's mainly P&C. It might be a little bit life. What surplus notes are, it's only on statutory, is you borrow money, but count it as equity. That'd be pretty cool, wouldn't it? borrow money, but they treat it like you issued stock. And that's what surplus notes are. Let's see who's issuing. Who is issuing surplus notes? See if anybody comes up. Doesn't really tell us. But you notice the insurance commissioner come up. Why does the insurance commissioner come up? So why in the world will regulators let someone borrow money, but put it in their net worth to give them more capital? And what the key to a surplus note is, you must have insurance commissioner approval, pay interest in principal. That's what a surplus note is. You have to get this, the insurance commissioner of state has to says, yes, you can pay your interest. Yes, you can pay your principal back. Most of the time they do, so it's unlikely they're not going to approve it, but that's the reason they let them count it. So why in the world would you do this? Because there's some companies, especially younger companies, that's why I wanted to look up when it happened, that they're starting off, they're not making much money, their net worth is really, really small. They need to somehow prop up their net worth, and the states have said, we'll let you do this. I wish I could tell you who's issuing it, because I thought Nationwide was doing surplus notes. You can see, I don't need receivable. Nationwide had 2 billion outstanding. So, you know, it was a sizable number. Why did they do surplus notes and not Allstate? I don't know. Now, it has to be on their statutory blank because you only need it for statutories. They'd have to do it inside the insurance company. Otherwise, you can't do this at the holding company. Wouldn't make any sense. But Nationwide for some reason does this, but I don't know why they did. Have y'all heard of Nationwide? They still in business? I don't watch TV, so I don't notice commercials. All right. Let me see if I can bring up the other file. So we can go from there. Is this 2023? All right, we'll keep going. Where did we get to? I'll go back to the income statement real quick, just see. It's a little small, a little large. Yeah, look at that. Underwriting losses the last 2 years. What does that mean their combined ratio is? Y'all gotta give me something. What is the combined ratio? 96 or 104 if you had a choice. It wasn't that many weeks ago, was it, that you did paper one? If you have an underwriting loss, your combined ratio must be greater than 1 or less than 1. Greater than 1, right? It's outflow over inflow. So they had 2 years of negative or combined ratios above 1. The previous 2 years before that was underwriting gains. So that's pretty serious. What's going on with Allstate here? So we'll see if we can see if it's the auto side. That'd be interesting to see. On the investment income side, yeah, I'm surprised their investment income didn't jump more with interest rates higher, but they did have realized losses. Their net income itself, 2 losses. That's pretty major for them to have 2 years of losses. All right, the next schedule is cash flow statement, and no one uses the cash flow statement for insurance companies. It's almost a useless. I don't know anyone who's ever looked at a cash flow statement for an insurance company for any kind of analysis. It's just of no value to you. The reason for that is when you collect premiums, that's really not revenue. You're picking up risk. You're just picking up risk. So a big growth in premiums may just mean much larger claim payouts in the future. So it just doesn't tell you much. All right, the next page is, we talked about the premiums. So there's the premiums. So you can see where they're writing a business. Just more detail on the premiums. More detail. What is direct business? Direct business is what they actually write without the reinsurance. All right, let's talk this. So I'm giving y'all some terminology here. In fact, we need this for Kirby here. So reinsurance, assumed Reinsurance ceded. Reinsurance assumed is Allstate receives premiums to insure another insurance company. That's assumed. That's going to increase their premiums. Ceded is Allstate bought reinsurance. Another. So you assume, well, look, I might get it wrong here, but you would assume ceded would be much larger than assumed because Allstate is not a reinsurance company. So if we look at the bottom line, oh, well, forget it because they're doing this with affiliates, so that messes everything up. But if non-affiliates is what we should focus in on. So it's 208 versus 401, so it is much larger on this on the seated. Yeah, who knows what they're doing on the affiliate side? That's interesting. All right, so here's losses. They do the same thing with losses, so you can kind of see we can't compare year to year, but you could get last year's statement and this one and compare to auto and see if the claims have been much higher. You could certainly do that. It's a little hard to read with it that small. But again, they break up direct business, assumed, and seated, and they kind of go all the way across with losses. So it gives you kind of a detailed statement that they do give the percent. Unfortunately, we can't look here. Let's see, where is auto insurance? Man, my eyes. Private passenger, there's the physical damage. That loss rate looks like 60%. The passenger liability, they don't look really, really high. They're around 70, so I'm not really sure. Even it's boy, that's numbers are too small. Here's another one. We're on losses, and they do have an incurred but not reported. So this is losses and loss of LE adjustment, just massive amount of detail. More by product line. I mean, it's pretty amazing. This is the expense exhibit. We looked at this before. It's pretty amazing the detail you get. You're not going to get this kind of detail in the GAAP financial statements. We looked at this last class.
So are there like teams of people that are putting all of these numbers together, or?
Well, USA, the year I started, they had something they called the bridge, because most of this financial statement is 700 and something pages. Most of it's on the investment side. And I'll show you why the investment takes so much. So before I got there, they must have been typing it all. And the year I got there, they had a bridge. So we went to our accounting records and pull all that stuff and put it in. So they had to build that bridge to be able to recognize how they're feeded in there. So it's pretty exciting, man. I'm walking in and they're all like, did it work? Did it work? And it worked. Now, my first year in this department, they had one subsidiary that wasn't on the new system, and I had to type their financials. And it was in this really big paper. And so I had to figure out how to put big paper in. Y'all don't even know what a typewriter is, do you? I had to put this big paper in a typewriter. So I'm trying to figure that out. And I look up and they're all sneaking around the corner seeing if I can figure it out and laughing. So I was the newbie. It was kind of embarrassing, but yeah, that was the year. That was the only company we didn't have just do it automatically. But yeah, it really sped it up. I can't even imagine. I wish I could have been there a couple years earlier just to see who's typing all this stuff, because I mean, 700 pages. This is a lot of detail. I do think what they got was remember we used to call this the blanks, the statutory blanks. I do think like in the 60s and 70s, they got copies of this without the numbers, and you just typed in the numbers. And that's why they call it the blanks. Those people were photocopying those, however they did that back in the 70s. But you've seen the TV shows, right? You have this room full of people typing. Just, you know, that used to be a whole career back then. They have an exhibit on the investment side. There's some really good information in here that you can use. You can see the detail that you get on the investment side. Unfortunately, on the bonds, they don't break out municipal bonds. That would be really helpful if we could. But you see the income they make there. Real estate, this number is probably rent that they're paying themselves. So it's kind of left pocket, right pocket. They pay themselves $54 million in rent, and then they have rent expense on the other side that you will see. Now, some of this could be rent they're getting from subsidiaries as well, that they're paying up for the company. That's the way USAE did it. We all paid the parent company. And then the capital gains, they give you the capital gains and show you where the gains and losses are there, which can be pretty interesting. Here's the non-admitted assets that you can get the detail on that for some reason. And then I'm going to skip through here, but just look at this. I've never read this stuff, but there's the notes to the financials. Look at all this detail. Someone must be reading this, right? Don't you think? Or not? Someone's typing it, right? Just page after page after page. And then you think, well, that's just too much. And then the next section, well, still more. You think you're done once you get through all the notes. I'm tempted sometimes just to stop and see what they're saying. Here it said legal and regulatory proceedings and inquiries. That sounds interesting, doesn't it? Who's suing them? What's going on? That seems like it'd be interesting. And look at all the detail. The company has a pending investigatory hearing before California concerning private passenger auto insurance rating practices of the company. The investigatory hearing is captioned "The Matter of Rating Practices of All State Insurance." I mean, that's some pretty good stuff. But are you going to read this whole thing, you think? I mean, you're curious what they're doing, what they're putting in there. What is this schedule? What is it telling you? Each class of asset or liability, you know, it seems interesting. But I don't know how many pages. I should have counted the first page. But we've been going, you got 30 pages, 40 pages. So let's see if we can get the end of this. Wow, word. It's crazy. How did they do this in the 60s and 70s? I can't imagine. All right. So you think you're done, right? Oh, we got through the financial notes. Guess what comes next? The state says, well, that's fine. That's your footnotes, but we have some footnotes we want you to fill out. And that's called the general interrogatories. Do you think that's 2 pages? That goes on. Look at that. Who's looking at this stuff? It's crazy. The state of Texas was so hilarious when we first started doing this on computer. The state of Texas passed a law that you have to file it in paper and on disk. Y'all don't know what a disk is either, do you? Have y'all remember the floppy disk and the 3? So the state, and so a friend of mine went up to the insurance commissioner, and there's this massive trash can full of disk that have been shipped in. And he was like, what are you going to do with that? Oh, we just throw them away because we don't have a computer that can read them. So we were all filing on disks so that they could throw it. We could have sent them an empty disk and they would have never known. So good state legislature say, hey, it means makes sense, right? Let's do this electronically. So that means the state, all they have this is in paper. And who is actually sitting down and reading these questions? How many pages have I gone? I should have got to get, so there's the interrogatories. That was at least 15 pages, wasn't it? Mm-hmm. So it's just crazy. And I've never, one of these days I should just sit down and read the whole thing and see, you know, you stop just randomly and say, well, that's kind of interesting. So there's really good stuff in there, but I don't want to read 60 pages of this. Does any reinsurance contract considered in the calculation of this amount include an aggregate limit of recovery without also including a reinstatement provision? Does that sound interesting to you? Doesn't sound, it sounds like when I filed my taxes for my charity, they have like 50 questions you have to answer. It's like, guess what I do now? If I said no last year, I'm saying no this year. I don't read the questions again. I was like, I'm just hoping it's the same answer. All right, then you get the 5-year. So this is gonna be interesting here. So we're gonna look at some loss ratios. Let's see. So here they have premiums. What do they mean by gross premiums? That's before reinsurance. They have your net income. Here you see their net income, 2 billion, 3 billion, 1 billion, -3, -2. So something's definitely going on. Their investment income, they had a huge investment year that year for some reason. And here's their net income, 3 billion, 6 billion, 6 billion, -1. So Allstate definitely going on. Total assets, that kept growing every year. Losses, you look at the losses, 33, 33, 40, 45, 50. You went from 40 to 50, 10 billion, a 25% increase. Where here, you know, not nearly as much. So again, it's going on. Your unearned premium reserve had a big jump. Here's the risk-based capital. Y'all remember how, okay, y'all can't embarrass me here. What's their RBC ratio? Y'all can do this. Prove to me that.
Which year?
You don't have to do the calculations. Just tell me how would you calculate it.
11 divided by 3 times 2.
All right, so it'd be 12 divided by 6, about 200%. All right, so y'all got that down, right? Here's their assets. Big jump in bonds for some reason. Big drop in stocks. The drop in stocks is probably not the stock market crashing because it didn't crash, but it's probably something going on with the subsidiary. But you can have to look that up. Look at their other invested assets. It's a huge number. Really huge number. But here's their affiliated common stock, and that look at where. So this raises the question: why did their affiliates go from $6 billion to $1.7 billion? What are they doing? There's something going on. Can you imagine interviewing for Allstate? You might ask them that question. They'd be pretty impressed. It's like, notice your affiliates went from 6 billion to 1.7 billion. Is there something going on with your structure? So interesting. Here's all their affiliated assets went from 7 billion to 2 billion. Capital gains, gross losses, property lines versus liability lines. It looks like they both grew about the same. And then you get not quite the combined ratio. I wish it were a combined ratio, but this is kind of a common size income statement. But look at losses. They went from 53% to 75%. You can definitely see there's an issue. Their expenses actually came down from 25% to 22%. So there's definitely something going on. And how in the world can their claims go up if their LAE comes down? So any of you are interviewing with Allstate, you actuaries? Say, man, I noticed your loss ratio jumped quite dramatically in 2022. You probably want to know what the answer is right before you get there. So you can find it in this annual report. You can find it by getting the detail by product line, which is in there, by comparing year versus year. You can really figure out how much of that is auto versus homeowners. Well, anybody know what this thing is? How did they calculate this, do you think?
Like the Schedule P.
Yeah, Schedule P. So what is this?
1 year loss of whatever accident. Yeah.
Yeah, the current year minus the previous year. And do you keep the negative or positive? So did they do reserve? This would be a great trick exam question. Did Allstate strengthen reserves or weaken reserves in 2023? What about 2022? Wow, word. Is that a good number or a bad number? So remember, the last year is what they ultimately think they're going to spend. And the previous one is what they ultimately thought they were going to spend. Did they have to increase that expected loss or did he decrease it? If it's a positive number, what is that? Is it reserve strengthening or is reserve weakening? So that's reserve strengthening, which is bad. So this is what did Warren Buffett call this? Oops. All right. What did they do here? Reserve strength weakening. They reduced the reserve. So that's pretty important. Here's premiums written to surplus. I don't know why it's well below 3 in the previous years. Here's a 2-year loss development. Look at that. Reserve strengthening, or oops, 2.6. How many undergraduate students interviewing with Allstate would bring this up? Because this is huge. $2.6 billion and they lost money. Did they lose money because they had a bad year this year? No, they lost money because they understated reserves a year and 2 years ago.
So
I
at
don't-
some point, do they go back and look at that to figure out why did they?
Well, this is where that Schedule P would be so helpful because you could tell which product it is, right? Because they do Schedule P by homeowners, autos. We could figure it out. And it's only 2 years back, so you could tell if it's auto, remember, only does 2 years, 3 years. So not only, let's say Jacob's interviewing with Allstate, not only could he ask the question, but he could also probably answer it. So, what happened with your auto and last year? Now you'd be scared to ask it, right? Because they may be offended, especially if you're talking to the reserver. It's like, wow, y'all, you do reserves, man. How did you mess up so bad 2 years ago? But it'd be an impressive question. It might not get you the job, but they'd be pretty impressed that you knew that, asked that. You can only ask that with the statutory. You can't do it with the gap. There's not that kind of detail in gap. So that's amazing. I'm kind of curious now to figure out what's going on. So the 5-year doesn't answer questions. It just tells you where you need to go look. And then you go look, and where you're going to look, you can go look in Schedule B. And that's going to tell you what you need. It's pretty amazing. So here you get to the point where you don't quite have it here, but over a couple of pages, you essentially get an income statement by product line. Pretty amazing. Premiums, losses, expenses. And you finally get to, at the very, very end, you finally get to the net income for the firm. No, I take that back, actually. All right, let's see if y'all see it. There's an important word on this page. Think alphabetically. Y'all see it? See it? Y'all see it? This is called the state page. Not only could Jacob figure out what that 2.6 billion, he could figure out if it happened primarily in one state, because you can go through every state in detail and figure out where that loss came. I mean, you can see why I love statutory. If you can't answer the question with this, there's no answer because everything is in here. So yeah, this is the state page. So we saw this up above. Essentially, you have this same income statement up above for the company, but here they do it for every single state. It's incredible. So yeah, Jacob could walk in and say, yeah, I was looking at your California state page and your annual report, and right there, you're the only interviewer that has said that. Out of the entire, they interview 50 people and they're like, man, that Jacob guy, he asks really hard questions. All right, we're up to New Mexico, Utah, we're getting close, Virginia. It even includes Guam and let's see what that is. Puerto Rico. That's what they do in Puerto Rico. Canada, other alien, whatever that means. Other aliens. And then they get the grand total, so you can look at it again. So amazing amount of information. Then you get in special schedule we won't talk about, although this is what Kirby does. I don't know how much he would feed to this, but you have special schedules just related to reinsurance. And just amazing, amazing detail. I mean, this is Schedule F. And you have Schedule F just going on from page after page. I don't know what questions, maybe Kirby will talk that one. I should find one of these statements from the 60s and see if it had all of this detail, because it almost seems impossible, doesn't it, for someone to type this every year? How many typers would you have to have? We're still on Schedule F. Part 6. Then we get the H. So H is probably not important because it's accident and health, which is moved mostly to the life insurance side, but there's a few schedules on that. Looks like Allstate does a little bit of that. All right, then we finally get to Schedule P. Now, where's I, J, K, L, M, N, O? I don't know. We go from H to, so we missed G as well, didn't we? There is a Schedule D, but it's at the end. So they're not really good with their alphabet, but there's a Schedule D. And so then you get to Schedule P. You know Schedule P, but can can we figure out which, well, let's go to the part 2. Can you figure out which line, which accident year was causing their 2-year loss development problem?
2021.
2021. So what happened in 2021? They initially thought it was 23 billion.
Jesus.
Now they think it's 24.6, so that's 1.2 billion, but they also increased you notice there's not many negative numbers in here, are there? So yeah, if you interview with Allstate's reserve. So the other question you might ask is, if I pull up another P&C company, do they show something similar, or is this a unique Allstate question? What if you pulled up a commercial rider like Chubb and see if it's I don't know how much y'all prepare for an interview, but for actuaries, you know, if you have a couple exams under your belt, you could do some incredible research that I assure you no undergraduate student is going to do, and I think you would blow them away. That type of analysis. This is the business. So they had a bad year, but they didn't have a bad year this year. When did they have a bad year? They had a bad year here. They just didn't know about it. Because remember, 2 years ago, they showed a positive net income, but really that was negative, and this year wasn't as negative. So that's the key there. So 1 year and 2 year loss development. Remember on the exam, you don't get this. This is what you're calculating. So I give you all of this, and you got to calculate that. So, all right. We could go through this and find which product it is. Here's the homeowners. So we'll go to the part 3 of homeowners. Now it just takes too long to get there. So I'll do it next class. I'll find it. So, all right. So we're almost done with the accounting. But you can answer almost any question if you don't mind scrolling 1,000 pages as you go, because it's just really tough. All right. We'll stop it there.